Hello friends, today we will be talking about a very important aspect of expected credit loss framework of Reserve Bank of India, which has been released on 27th April 2026, and it will be effective from April 1, 2027, and it has a glide path, it has a transition time up to 2030-31, that is the financial year 31. So 4 years of time to the banks to migrate to the expected credit loss framework. It will involve additional provision on the expected credit loss that every bank will have to estimate, will have to make projections. So far, we have been making two kinds of provisions. Provisions against standard assets, that is, the entire loan portfolio. There are certain sectors. Amount of provision ranges from 0.25% of the loan portfolio up to 2%. So that is the existing framework of provisions against standard assets. So that is one part of the process. The second part of the process is when a loan account becomes non-performing after 90 days of default, it is classified as substandard, where in the first year the provision is 15%, second year it is 20%, it goes on up to the fourth year when it is made into 100% provision. That is, in 4 years, every bank has to make a provision of 100% against unsecured portion of the loan. Purpose is to ensure that even if there is a total default, the bank will be able to cope with that kind of a loss. So that is the second kind of provision that we have. Now, the expected credit loss framework works on a method that the banks will be running into a credit risk between 0 to 89 days, because between 0 and 89 days there is no provision for the expected credit loss during the time loan account conducts itself. So now this expected credit loss framework is in alignment with IFRS standards 9. That is a compliance of IFRS 9 standard that already about 110 countries have already implemented this framework, and now RBI has brought it and introduced it in India, because by now most of the banks have the necessary kind of data, necessary kind of wherewithal, necessary kind of infrastructure to be able to implement this framework. This framework will be bifurcating the loan portfolio into 3 stages. Stage 1, overdues between 1 day to 31 days. Between 1 day and 31 days of the life of a loan portfolio where there is a overdue, nothing is to be done, because we have got standard provisions between 0.25% to 2%, which I have earlier discussed. There is nothing to be done, and the ECL framework defines it as stage 1. So stage 1, existing provision coverage will be able to manage the losses. But when the loan account is 31 days to 89 days, this is called stage 2. This stage 2, right now, there is no additional provision that we make. Only the standard assets, whatever provision is being made, it runs until the account becomes non-performing. That is when it completes an overdue period of 90 days. Then we classify it as a non-performing loan, and then the usual prudential norms of IRAC norms will be applicable. What is IRAC norms? Income recognition, asset classification and provisioning norms will be applicable as per the prudential guidelines. So that is the thing after the account is classified as a substandard. But between 31 days and 89 days, as of now, the banks do not do anything. Now, the expected credit loss framework suggests that you should be able to keep a track of what is the expected credit loss in your portfolio of loan from 31 days to 89 days. Risk proof during this period, it is not possible. So there will be some kind of an likely elevation in the credit risk, and that is what is to be captured by the banking system. and additional provision of 5% is to be made for stage 2, and for MSME accounts it is 10% of the gross defaulted amount, which is showing in the SMA data. See, banks have the system of capturing the special mention accounts data, that is SMA 0, that is up to 30 days, where it is stage 1, where we do not have to do anything under the expected credit loss framework. SMA 1, that is 31 days to 60 days. SMA 2, 61 days to 89 days. So this window of SMA 1 and SMA 2, we will have to run different kinds of models to assess what will be the expected loss, and right from the beginning, that is on the 31st day, you should be able to make provision for that kind of credit risk which the banks have already assessed. That is the crux of expected credit loss framework. That means portfolio which is expected to be overdue between 31 days and 89 days, banks will have to make additional provision. That is going to be some kind of burden on the banking system, as they are not making any kind of such provisions as of now. So the expected credit loss framework is going to impose additional provision for that purpose. I'll just explain the whole concept. Thus, the ECL is not a standalone reform. It is the culmination of 4 decades of progressively tightening asset quality standards, each reform triggered by the inadequacy of the previous one. ECL is intended to address the deepest problem, sensing credit risk before it actually turns into a loss, rather than after, and is designed to address the core problem by shifting away from the current incurred loss model to preventive loss model. And in short, earlier banks were essentially waiting for a borrower before setting aside money for the loss. That is, unless it is categorized as a substandard, we don't do anything. Compared to that, it was a reactive posture that 2008 global financial crisis has exposed, that it is dangerously inadequate provisions that the lenders will be making. That is why ECL framework is now designed to be on the 3 pillars. What are those 3 pillars? First is probability of default, loss given default, and exposure at default. These 3 things have to be assessed by the banks for their credit portfolio, and at least minimum 5 years data is required for this purpose. And each parameter captures a distinct element of credit risk, and together they determine the expected loss under which baseline and stressed macroeconomic conditions are taken into account. ECL model, as I was telling, divides all credit exposures into 3 distinct stages. Stage 1 covers performing loans with minimum credit risk, that is up to 30 days. Stage 2 kicks in when credit risk increases significantly, that is, when the overdues rise beyond 30 days. And stage 3 covers credit risk or impaired defaulted assets. Provisions to be made for stage 1 as is made against standard assets now, like whatever we are doing for the standard assets. Loan provision is raised to 5% for stage 2 and 10% for MSME loans. Significantly higher provision is mandated for stage 3 depending on the duration of the default. So this is how the framework is going to work. And RBI has emphasized robust governance requiring board and senior management to oversee ECL implementation. It requires a lot of homework to be done by the lending institutions. A committee of the board, including the CFO and CRO, must ensure the data integrity throughout the entire computation of ECL life cycle, depending on the probability of default, loss given default, and exposure at default, are effective and are able to compute the ECL estimation correctly, and complete independence of the internal model validation is required. What are the challenges for implementation? There are a couple of challenges that the banks will be facing. First is the data integrity standards. They will have to continuously mobilize the data and go through the data points that they collect from the operations, and they will need to have historical data systems, granular data analytics, and credit professionals who can collect, collate, and assess credit risk. Banks can phase in the difference between expected credit loss based provisioning and existing IRAC cap, that is income recognition asset classification provisioning, over 4 years from 2027 to 2031. They will have to run them parallel, and then they will have to move over to the next stage. This will have implications on the capital, because when credit loss is estimated and provisions are made, then it will reduce the profits to that extent, which normally gets added to the capital at the end of every quarter. That will be impacted now. And the new stage 2 minimum 500 basis point and 10% provision for MSME loans will materially increase the annual provisioning against bad loans. That is the expected bad loans. They have not yet become bad loans. So that is the ECL framework is a structured upgrade to India's banking regulation aimed at making the system more resilient to future shocks and at ensuring earlier detection of credit risk. This is the ECL framework, expected credit loss framework. Lot of discussions are happening in the banking circles about this. So on similar trending topics, we will be talking as we move forward. Till then, please watch these videos and share with your friends, and subscribe to this channel, which is meant for disseminating knowledge and sharing the implications of regulatory guidelines given by RBI from time to time and the developments that keep happening. So till then, stay happy and stay healthy. Thank you so much.